Okay, ladies and gentlemen, with this, we move on to the next panel discussion. The topic at hand for the next panel discussion is funding prospects, portfolio diversification, and new investing models. Let's know a little bit about the moderator for the session. Well, our moderator for this particular session is an investment banking professional with a diversified experience portfolio of over 16 years in the real estate industry in capital markets, project acquisition, NBFC lending, advisory and valuation services. His key strength is in business development and transactions across Northwest India. Please welcome the moderator for this session, Mr. Ashwini Sharma, Senior Director, Capital Markets and Investment Services, Colliers. Well, it's time to introduce the panelists for this particular panel. I shall introduce the panelists in an alphabetical order. Our first panelist to join us has been instrumental for successfully managing multiple real estate funds, including setup of more than rupees 300 crore real estate fund for Lal Bhai Group, Urban Limited, as Managing Director and CEO from 2011 to 2020. He has been a part of Motilal Oswal Real Estate Fund and Real Estate Team of ECT Ventures. Please put your hands together for Mr. Anuranjan Mohnot, co-founder and MD Gruhas and Lumos Alternate Investment Advisors Private Limited. Well, ladies and gentlemen, I don't think so that this is a news, लेकिन तालियों पर GST नहीं लगता, तालियां tax free हैं. Thank you. Let's welcome our next panelist. Well, this certain gentleman has more than 25 years of experience. He has been associated with the organization for 13 years and drives strategic initiatives for the group, manages key relationships with funds, investors, and intermediaries. He's also instrumental in reviewing and advertising investments. Please put your hands together for Mr. Kaushik Desai, Managing Partner, WSB Real Estate Partners. Such a kind audience. Thank you for the lovely applause. Well, our next panelist is responsible for deal sourcing, investing, monitoring, managing exits, and fundraising with focus on North and West markets, that is Delhi NCR, Mumbai, and Pune. Prior to joining Motilal Oswal Real Estate, he has worked with ASK Property Investment Advisors focusing on real estate private equity. Ladies and gentlemen, please put your hands together for our next panelist, Mr. Nihar Thanawala, Director, Motilal Oswal Alternate Real Estate. A louder round of applause for the gentleman. Thank you. Up next, our next panelist is responsible for managing the financial performance of the organization that he's associated with. He has an experience of more than 2 decades, that is more than 20 years in the industry, in streamlining business operations that drive growth and bottom line profit. He has hands-on experience in forging partnerships with financial institutions and private equity players and has been credited with successfully managing foreign direct investments in the organization. Please put your hands together for Mr. Santosh Agarwal, ED and CFO Alpha Corp Development Private Limited. Our next panelist has been a dedicated counsel with more than 16 years of experience in the legal sector. Well, quite needed. He is a managing partner at Satram Das B & Company and has been practicing as an advocate in the Supreme Court of India, High Courts, District Courts, and other forums and arbitral tribunals. As an additional advocate general for the state of Haryana, he represented the state departments before the High Court and has advised the government of Haryana on legal affairs. Please put your hands together for advocate on record, Mr. Siddharth Batra, Supreme Court of India, former additional advocate general, Haryana. And to complete this eminent panel, Our next panelist has over 25 years of work experience in the Indian real estate sector and is the founder of Black Olive Ventures, a real estate valuation advisory company. He has previously worked in senior roles with Colliers, HSBC, ICICI Ventures, and was the CEO at SARE Capital. He is a council member of the Institution of Valuers, board member of NICES Finance, and on the investment committee of the Dalmia Nesas Real Estate Fund. Ladies and gentlemen, completing the panel here with us, please welcome Mr. Sunil Agarwal, founder and managing director, Black Olive Ventures Private Limited.
Hello, good evening, everybody. Am I audible back there? Right, thank you for attending this, and thank you, the speakers, for attending this conference. So, ladies and gentlemen, the real estate industry over the last few years have seen many disruptions, be it your GST, your demonetization, your RERA, or of course, needless to mention, the pandemic. There's been too many ups and downs, or too many troughs and crests what the industry has witnessed, and which has led to performance maybe down south for the development, the sales, and of course the financial institutions. But post-pandemic, we have seen a sudden upsurge in terms of your the land prices shooting up, your sales of residential, your commercial stock, the absorption of commercial office space picking up in a very unprecedented manner, and your financial, your private equity infusions being to the tune of around, say, $3.5 billion in this year across various other asset classes, not only your office and residential, but warehousing and other alternate usage. So this session will be discussing primarily with respect to your various funding or new investment models for various asset classes or various portfolio which developers are keen on exploring or envisaging to develop. But having said that, what are the government policies, how they should support going forward, and whether these, whether the financial institutions are comfortable on those lines. So, Sunilji, I would like to start with you first. Since you have been witnessing the both sides, your valuation advisory, both from the fund and from the developer side per se. So, with your interaction with the financial institutions, so what has been the, your perception or their perception on account of new investment models or new investment approach to other asset classes?
Okay, so I think the funding world coins these new terms every time. So it's the same wine in a new bottle. So, I mean, when you look at diversification, yes, there has been diversification into a few new asset classes, which could be logistics, which could be going for even data centers. So we evaluated data centers. We didn't know anything about it. Thanks to the IPCs like yourself, we got educated. But coming to funds specifically, we see funds stick to one model and one asset class. So most of the funds that you see will either have a focus on residential or commercial or a particular asset class. What is happening is that when we look at the deal structure, there are pools of capital which are being raised at different expectations of the investors. So the investors who are happy to give money at 9-10%, but they want a very safe investment. So that could be, stabilized assets. Fast forward, somebody would be very risky. They could lend at 22, 23, 24%. They're willing to take the risk appetite of a land acquisition. And there will be others who will be looking at a 14 or a 15 or a 12 or a 18. So I think one trend that we are seeing is that when we look at a project, it comes to us for evaluation at a land stage, then it comes to us at the construction finance stage, and then it comes to us at a mature stage. So I think different pools of capital. The other models could be very similar. I mean, you could look at plain vanilla deal or an equity kicker. Itna milestone hua, uske baad there is a sharing that happens. Fractional ownership has come to us. Now, I don't know how legal that is. I'm sure there are people who are more educated, but I do see that this is no different from collective investment scheme. But theek hai, chal raha hai market mein, let SEBI take its own call, but fractional ownership has come to us. So, I own a very large piece of, leased out property. My share is so much, so what's the value? That's a kind of transactions that have come in. So I think there are also managed accounts where there is a fee paid to somebody who's managing it on behalf of, let's say, a larger fund. So there are different models that are emerging that have been there. But senior, junior, that's also the last thing that we've seen, that I come in at the last mile stage. मैं last mile पे आता हूँ, मैं 100 करोड़ रुपए लगाता हूँ, हो सकता है उससे पहले investors ने invested 300 crores, but I'm senior to all of those. So maybe I'm taking advantage because today I have the money and I say मैं 100 crores में मैं senior बन जाऊँगा. So we've seen a lot of these deals where the sliver of equity is very small or sliver of funding is very small, but the guy says, since you've now done all the mistake, मैं बचाने आ रहा हूँ तो मेरे को senior role दे दो. So that's also one new flavor. So I think diversification and new asset classes, all of it, primarily is the same thing. You know, when I'm taking more risk, I need more return. So whether it is senior, junior equation or whatever you call it, but yes, these are the new trends and terms that we see in the market today.
Thank you so much, sir. But as you rightly said, the risk appetite, and that's how the returns are being devised or being back calculated at. But on the other hand, there are new collaborative structures also, which are being adopted by developers in order to ease the pressure on a financial institution where there are 2 or 3 credible parties involved. Say, for example, it could be a development management model where the roles and responsibilities are clearly demarcated, and one entity is focused on driving the sales, and the other entity is taking care of the approvals. So, Santoshji, your firm, of course, has seen Gurgaon right from its inception, and it has developed key marquee commercial and residential assets as well. And recently, you have been diversifying into the other stress assets, your NCLT, your IT offices as well. But your model, or your collaborative model, has undergone a change in some aspects, say with respect to your development management. But I would like to understand, or the team would like to understand out here, how effective it has been in mitigating the risk of financial institutions once you interact with them for your investments.
So yes, we have been involved into the development management model, which is a little different model. What generally the real estate industry follows is a joint development agreement model, where somebody is contributing land and the developer is developing on it. So this is one model of the collaborative model, where the risk has been divided into 2 parts, is the landowner and the developer. In a development management model, here the complete risk has been divided into 2-3 parts. One is obviously the landowner. Another is the development manager, who is taking part into the complete management of the project. He is managing the project. He is ensuring that the delivery happens according to the agreed parameters and ensures that it delivers on time. With respect to financial institution, development managers play a very good role in that sense, that they keep updated the financial institution, actually what's happening on the ground. So sometime if you go back, that the lenders used to appoint lenders engineer to know actually what's happening on the project. It was always been on one side of the project about the development of the project. It was never on the marketing and the regulatory aspect of the project. When the development manager comes in, he looks after all this by one angle, and he is the master on the ground who controls everything and then tries to mitigate the risk of a financial institution. So financial institutions can rely very well, since these are mainly professionals who runs the development management model. It is not that it is somebody who is owning the company and running it. It is the professionals who runs it. They understand that in the market, if they are delivering good, they will grow according to the market. That's where the development management plays a very vital role, and it actually mitigates a lot of risk. So if some risk of the cost increase and something comes out, they can accordingly restructure or rework the numbers for the financial institution. They can preemptly intimate to the financial institution that whether you are going to make the expected return out of it, or you should make provisions, or the developer needs to do something on that. So that's a development management model where it plays a very crucial, or we have been instrumental in this. We are doing this since 2003. And we have seen that wherever a development model has come in, the project has been completed on time, and there is a less regulatory risk, since when the professional comes on board, they do not want to take any chance that, okay, we will see it later on. They want to, if there is any risk, they want to take it on that part, and they want to regularize those things. So there how the project gets delivered. So we have done 2-3 projects on a development management model, and we have been able to successfully deliver the return to the investor, return to the banker, and obviously buyer, who is the ultimate beneficiary of that. They are also benefited that, yes, we are getting the project on time. On other collaborative model also, where it comes that the landowner is putting land, your developer is putting their money for the construction. Here also it plays a role where the financial institution can be, if a development manager comes in between that, then they can mitigate the risk, since we will keep updated. If there is any loss, they will keep updated financial institution. They can guide the financial institution, look, if the investment comes out, you should take an exit. If that kind of, so what lender engineer used to do, somehow this development management model has been supporting them.
Thank you so much, sir.
Can I just butt in for 1 second?
Yeah,
Sorry
sure,
for
sure.
this. I think one should look at development manager not as a sole service provider. They should also put in some equity in the game. So the recent transactions that we've been involved with have had either a DESRA guarantee given by a developer, or put in a small sliver of their equity, or even in some cases, the development manager has a very successful project. Uska cash flow also is escrowed. So I think what Santosh said is absolutely fine, but I think the financial institution looking for development managers also not only just making a fee out of the game, but actually then delivering a value. So दो तरह से, one is you putting in some risk, capital or some cash flows, etc. The other is आपका brand मुझे अगर मैं 100 रुपए पे बेच रहा हूँ तो क्या 110 पे मुझे rate दे रहा है नहीं दे रहा है.
Exactly, Sunil.
So
that is what the
that's where
development
I
manager
think
is contributing.
Yeah.
So here what happens, some models is the development manager delays its fees, that once the project reaches on the completion or reaches on the where it has got the success, and some of the fees are linked to its performance. That if this is, you are getting this price, you will get this, if this is the, and sometimes it happens that development manager also invest along with the investment managers.
Very well said, sir. Since the whole focus of a collaborative model is to revive or evolve a new development style to complete the project, having said that, one cannot miss the last mile funding or the investment into stress projects. So, Anuranjan, my question to you, you have been a private equity investor in Oswal Avatar, and you have invested. Of course, the quantum has been limited to a certain extent of around 30 to 40 crores or up to 50. And recently, you've been focusing on a new investment model where you will be providing a last mile funding for stress projects. So what was the thought process, or what was the rationale behind just changing this investment model for Gruhas and Lumos?
See, coming to the NCR market first, I think, am I audible? Yeah. So this is, I think this is the most opaque market in the entire country. This is the biggest market, real estate market. And this market has witnessed one of the largest number of developers in jail. Okay. The issue here is that, the kind of stress which real estate developers in NCR has produced, it has given problem to entire real estate sector in country. All listed real estate companies, all, I think it has given bad name to all lenders also. So the need here, what we have seen is that in India, more than 5 lakh units are either seriously delayed or stalled. It requires large number of capital, huge capital to revive this. The market, there is an estimate by one of consulting company that at least 1.5 lakh crore rupee is required to revive these projects. Of course, it requires a lot of regulatory push to expedite the process of investments in these projects, which unfortunately, we see that, it's not that much happening. and the revival is taking its own time. So the size is very large. There are multiple NBFCs or banks who are downselling their stress books, who are going out and they are looking for a solution for reviving or completing the existing project. Size is big, and what we see is that there are many projects which are quite viable, which can be completed, which can be delivered within the next 2 to 3 years. It requires a last mile of money, which can be pumped in, and and the project is completed. Our original model was to do only equity transactions. We have done multiple transactions in Bangalore, Pune, Chennai, Ahmedabad, Mumbai, where the focus was to do equity transaction, come at early stage and provide an equity solution to a project. But unfortunately, in last 6-7 years, the kind of stress which real estate sector which has produced, it has changed the entire philosophy of most lenders in the country. I think to my knowledge there are hardly any equity provider in the country, because most of investors in India, they don't have faith in lending to in giving money to a real estate developer on equity terms. They are more comfortable in providing debt. What really we need is equity, because the stress which was produced in NCR market was because of leverage on two parts. One is leverage by borrowed capital or leverage through the receivables or customer receivables. And that created a problem. Not enough equity was there in the project, and finally the model collapsed. The need is equity, but the money which is available is that. I think we all, as stakeholders in the in the industry, need to revive the confidence of investors to bring back equity in the system, and that is what we I think it will take some time. We changed our model from equity to debt, just for the reason that huge corporate governance issues, huge problem in the industry, and lack of, I'll say, focus on delivery and leverage.
Very well said, Anuranjan. But having said, with respect to your idea of the performance of the market, NCR, of course, now has been on an upswing, and the sales performance with respect to other asset classes, not only residential or commercial, but other government schemes, or say Deen Dayal, or say your farmhouses, things have been on an upswing. And I think that's what, Nihar, my next question to you is that you have been away from NCR market for a longest time, but now, recently, over the last 2-3 months, we have seen close to, say, $100 million being invested by your firm, entering into NCR. So what made Motilal Oswal Alternates come back to NCR? Was it your sales performance, completion of projects, or diversification into new asset classes, not only core residential, but other asset classes as well?
So, I think if you go back to about 2000, maybe 13, 14, NCR was 50% of the entire residential market of India. If you leave aside the fact that Bombay has high capital value, even today NCR would be one of the largest markets. So I think it was more about a matter of time, right? So it was about when and not if we will come to NCR. I think what has happened is it's gone through a fairly low period, right? For various reasons which we are all aware of, from 2013-14 all the way up to the COVID period, where there's been a lot of churn when it comes to developers, when it comes to projects, it became overbanked. But I think the last year and a half, when almost all markets kick-started, NCR also benefited tremendously. So I think it's a market which we have been watching, studying fairly actively. We started looking at transactions about 12 months back. because we also want, there's a new breed of developers also that has, kind of really built business, good business in the last maybe 5-6 years. So we took our time, but I think when we got comfort based on the way the sales have been, the way some of the developers are truly benefiting from the consolidation, that's when we decided to kind of take a leap and invest. Even going forward, I think we will see NCR becoming a market where we will put certain percentage of our capital on a year-to-year basis. And I think the idea is, like in most other markets, we've identified a few partners. So it's a mix always. There'll always be 3 or 4 partners with whom we'll end up doing repeat business. And the idea will be to keep adding more as our book size grows. The same approach will be adopted in NCR. And we will look at it like it is a clean slate, rather than having the entire baggage of the past. Because if you go with that baggage, it'll be impossible to invest in NCR.
Understood. So when it comes to structured investments, of course, Kaushik, you have been doing this for many years when it comes to Walton Street, now the WSB Partners. We have been investing into affordable housing and, of course, a bit expensive capital, I do understand. But the whole idea has been to provide solution to a stress case and all. So my question to you is that when it comes to your new investment models, are you looking at any particular or other asset classes providing a similar set of, be it residential or say commercial or any other asset class? Not geographical per se, it can be NCR, South, West, anywhere.
Thanks. So primarily any investor will look at risk-adjusted return, and which is where all strategies will drive. And from a development perspective, I think what the respected panelists have already said, I think what has to be looked is what is the delivery. If it is residential, the customer should get home. If it is office, ultimately it has to be leased out. People should come and work there, or same for warehouse. So to do that, the financial closure of the project is very, very important. So our investment thesis, and Anuranjan and Nihar would agree with it, that ultimately we are looking at whether development partner come in or the developer himself bring in equity, or whichever way the customer pre-sold. There has to be a financial closure of the project, and which is where our money should come in, and ultimately we should see that all lenders, equity stakeholders, customers, all should be delivered. It's not just one portion. I mean, we are all together, right, in the project. So one segment of the investor will get exit and customer will not get their apartment, will not happen. It has to be, everybody should come together and complete that project. That's where the exit will come in. And that's where, I mean, as an investor, we'll focus on the financial closure, whether our money is going in the right direction, which will give closure to the asset, and hence it will get delivered, which is where our returns will come in. And that's where everyone's success will die. So that's what we'll do. So I think all investments are structured towards that. So whatever we do, whichever market it is being. I agree with Nihar that if we look at past, I think we'll not be able to invest in any geographies. We'll always have to look at, what are the new things happened in each of the market. And that's where you look up to like NCR as well, right? I mean, it's kind of, it's changing. After COVID, we have seen how the sales are being resilient in this market as well. The older projects are getting revived. Sometimes government push is also required, like in Mumbai, 50% cut in stamp duty or premiums had created this entire demand for residential real estate. So there are various ways you can create demand, but I think it's kind of complete genre. People have to come together to make sure that, okay, going forward, this market is being out of color for some time. Some way, it's large market to ignore. So some way it has to come back.
So these are the 2 pillars of financing and development, but when it comes to the government policies with respect to expansion of a city, that also, I think, plays a major role out here. So Siddharth, Mike, next question to you would be here that since you have been instrumental in providing various solutions to all the resolutions of the past NCLTs and all, how perceptive both the entities affected in the NCLT process are conducive to a new investment model, and what steps the government should take in terms of providing various other asset classes in terms of policies. both are different, but I think they both are linked when it comes to moving a step ahead.
So look, when you talk about NCLT, it comes under the IBC code, which was brought in recently in 2016. Before that was a completely different model, where stress assets were handled by the bank on their own, and things were happening left and right, and that is why NCLT was brought in. We haven't had much jurisprudence, or I will not say much or many successful cases as such. I've seen Unitech, which is though not under the IBC, but Unitech was, the board was taken over by the government, and Supreme Court is monitoring that. And after that, it's been about maybe 3 years, the matter has been pending in the Supreme Court, but there's no resolution in sight because there are so many multiple problems the erstwhile management created, which is a very difficult process to sort it right now. And if you see the case of Supertech as well, it's right now under the IBC, but I don't know when the resolution framework will come. Resolution framework did come, but the NCLAT, that's the appellate authority, has said the resolution framework. With every stress assets, there are difficulties because you know that we have our land laws, which most of the panelists will agree with me that as far as NCR is concerned, Delhi as a NCR is from 3 sides is Haryana, and on the one side it's UP. As far as Haryana is concerned, what experience I've had, the policies are basically translucent. And there have been gaps. We've had multiple master plans which have come up. The way things should have been, if I remember correctly, when I was serving with the government, at that point of time, for Gurgaon, the master plan was brought in terms of what maybe Singapore as a city had. But I believe then those changes in the master plan and all those things have brought instability somewhere. Government should have more clarity, I think. The Town and Country Planning Department in Haryana, which looks after all these development companies, development projects, I believe needs a complete sea change. If you see, while we were inside discussing, they said all the players which are in the south, maybe Hyderabad, Bangalore, do not want to come here. Why they do not want to come here is because maybe the policies are not clear. Even I believe at some point of time, the officers are not even clear about the policies. That's a change which I think I would ideally like to seek. But if you see another example of NHI that way, which has been bringing, development by connecting all parts. We've had KMP in Haryana, which is connecting from Palwal to Manesar to Kundli and then goes to UP. And after that also, NHI has done, I believe, a great job because the clarity has been with the land acquisition. When it comes to law, it's difficult for authority to acquire a piece of land. And I think NHI as a model has had great success with it because if you see the way roads are coming in the country is exemplary. But the same way, as we were discussing, Sunilji was mentioning that we do not have a rail transport as of now which actually covers the whole NCR. NCR sitting here maybe looks small, but NCR even goes till, Santoshji will agree with me, till Karnal, where their project is. So NCR has gone that beyond, which is about 120, 140 kilometers from here. NCR is no longer a smaller area. Yes, there needs to be, from the side of the government, there has to be, one at the town and country planning level. Second, I believe the rail transport maybe, if that can be there, obviously, yes, benefit. Coming back to resolutions is what you asked me. Under the IBC framework, IBC is still at a very, very nascent stage. And I'm yet to see any really success stories which have come up. Because once a project goes in stress, I believe all people here in the panelists coming from the real estate will agree that time is the essence now. Once you have a project, there's a timeline when you have to deliver. And the problem I see with the builders is also there because I've done litigations for builders as well. The problem is that not all the allottees pay on time as well. But the perception which has come outside is that if the project is delayed, no, everybody will run after the developer, maybe for refund or file something left and right for getting the possession. But at the end of the day, the other allottees who are there, the percentage of allottees who have for some reason not paid, which is affecting the complete project as well, I believe is somewhere overlooked, if you ask me. Yeah, that's what I think.
You like to say something? Yeah.
See, IPC envisages that, every problem has to be resolved within 6 months or within a definitive timeline. And now 6 years or 7 years of IBC now. And you are saying that, are suggesting that not many projects are resolved till date. Do you think that given our legal system, is it really possible to find solution within 6 months? Or let's say within 1 year, given, you have NCLT, then Appellate Tribunal, then, High Court, and then Supreme Court, and, all these processes where every dispute is heard, and before hearing or, during hearing, it stays a normal process, Do you think that can we achieve this, a 6 months period of resolving any IBC dispute, particularly in real estate?
Look, you'll have to ultimately take all the things in consideration when you really want to see why there's a delay. We've had logistical issues as well. I don't know whether you followed or not. Just 15 judges have just been appointed a week back as the members of the NCLT. And yes, there have been vacancies in NCLAT as well. I am doing a litigation in Supreme Court. If you see the IBC code, the limitation for filing an appeal is 30 days and 15 days condonable. That if you come after 30 days to enclad from an order passed by the NCLT, then 30 days you get as a matter of time. But next 15 days, subject to if the NCLT thinks, yes, there was some reasonable cause. My client files right on the 15th condonable delay. NCLAT says, no, nothing doing. You've come at such a last hour, your delay can't be condoned. Then when I was reading the matter, that NCLAT appeal has been itself pending for 2 years. Now we've gone to Supreme Court and said 15 days you're saying is not condonable, but the matter has been pending for 2 years. But if you read the newspapers, our new Chief Justice of India, Justice Chandrachud, another dynamic judge and a great judge that we have at the helm. Look, he is, if you see today's newspaper also, he said Supreme Court in US and UK only decide about 150 cases in a year. Can you do that in India? No. There is I'm not talking about NCLT as such, but there is a great pressure over the courts as well. If you see the Supreme Court itself, a Supreme Court judge on an average every day is reading about 80 matters. So there's a lot of stress on the system. But yes, you're right, IBC court, the insolvency and bankruptcy, the whole thing actually loses in importance if you take so much of time. And usually we are seeing that the resolution is coming, 60 days, it's been a few years as well. Yes, things have to change. There has to be something which limits everything and gets to that pace. But we're yet to see because of, I believe, the logistical issues that we have at the moment.
So thank you so much.
Anuranjan, just to add here, IBC process has not considered per se the real estate problems. Real estate problems. They are dealing everything by one stick. Yeah. The problem in the IBC is they have not come out with a solution since real estate is not per se that it's a manufacturing unit. Yeah. Problem is real estate involves many stakeholders. IBC has not provided till time that way out. Whether it's a regulator, whether it's a buyer, whether it's a developer, whether it's a financial institution. The problem in IBC is like if a housing finance company finances a home to a buyer, there is no provision in the IBC how his loan is to be taken care in the IBC process.
True.
Okay? Since he is not a direct creditor to that corporate debtor. Problem is that still our IBC process is evolving. Still, stakeholders has to represent before the IBBI that these are the shortcomings which are there. I agree to the Mr. Batra's point that there are vacancies and all that. In spite of that, if you hear the matters, every day these benches are hearing more than 50 cases in detail, and if you go for adjournment matters, it's more than 150 matters in a day. 400. So Mr. Agarwal is saying it's 400. Can you imagine, and do you think it is humanly possible for a person to read 400 files on 12 hours and then hear that in next 8 hours and then deliver the judgment? It's not possible. Thereafter, there is no clarity. If you go with the IBC law to any department, they say, we are not following IBC. We have our own law. If you go, environmental has its own law. Down in country planning has its own law. Explosive has its own law. So there are 10 different laws. You don't know how many laws are actually affecting real estate.
Santosh, I have one, I think you brought out a very important issue. Real estate is an asset class. So one has to realize that out of many asset or 4 asset classes, this is an asset class, and therefore it has so many other dimensions. Classically, management, if you read, has been built around manufacturing. If you read all the tax laws in the country, they've been built around manufacturing. What I have observed in almost 30 years of my career now is that real estate is the most ignored, asset class and the least understood asset class. So we are not part of GST, and therefore you have double or triple taxation. नोएडा में आप ज़मीन लेते हो, उसका रजिस्ट्रेशन कराते हो, उसका प्रॉपर्टी टैक्स देते हो, स्टैम्प ड्यूटी देते हो. Then when buyer kind of buys it during the construction, 12% GST, and जो आपको GST की rebate मिलनी चाहिए because your input credit taxes are not, that is not applicable. On rent, we are among the top 10 or 15 economies in the world जो rent पे service tax लगाते हैं और GST लगाते हैं. So I think the problem is that once you look at real estate and its complexity or simplicity, we are a very simple business. Area, rate, and everything else is law. So at the end of the day, I think there must be a representation made to the government. It has been done many times, that real estate needs a little different approach when it comes to litigation, when it comes to even tax laws, when it even comes to financing laws. And world has evolved. So हमारे पास ना तो TIF bonds हैं. I mean, yesterday we were trying to raise, brainstorming कि सरकार के पास पैसा नहीं है तो कहाँ से पैसा लाओगे? And in abroad you have universities for a building, they're able to launch bonds and get a tax concession and do that. So I think this is something that has touched the core of what that's why.
Sunil ji,
we are running short of funds. If today we want to raise funds, there are 10 different things which we have to think before even thinking about a bond. Indian bond market is not developed like it has been developed in Singapore or London. If we go to our investors for a bond market, they will say, no, I am happy to buy a bond of the IDFC and all that. They are not happy to buy a bond which is floated by a real estate fund for that sake also. Real estate fund also have to go and solicit funds from their own individual network. There is no proper working or the laws let down or regulations let down that, yes, you can do that.
So that exactly brings to my question when I asked Siddharth about that, saying how conducive government or how supportive a government policy should be when it comes to expansion to not only residential, but other asset classes. So even if I have to discuss with Nihar and Kaushik, would you, as financial institutions, be comfortable providing growth capital or investment into land when the markets are on an upswing, where you see stability going forward? I do understand, Santosh, what you're referring to is that a developable economy, it's on an upswing, it takes time to settle and establish itself. And that's what
Absolutely.
I think we are going through right now. Certain metros, they have done REIT because that segment has been established and settled and created. NCR, to say, is showing signs towards that. But we need support of the financial institutions coming in. So that's what Kaushik and Nihar, I would like to understand from you. Would you be keen with your existing partners to various asset classes funding into that, or expansion into tier 2 cities, where again there is a demand and supply gap?
So I think two things, right? One is about expanding to other asset classes. See, I think one thing that we've been talking is that I think across the board, we are really at a nascent stage of evolution, right? Whether it's things like IBC, whether it's like the bond market, even SEBI. SEBI is going through its own, sets of thought processes which are getting formed. I don't know if you're aware, but in the last 1 month, they've come out with 3 different regulations. Not regulations, but clarifications which have been confusing, right? Anybody who has an AIF has been suddenly thinking that, oh, what is right, what is wrong?
Sunil has...
Nihar, you know,
the
what is
AIF
happening
regulations that have come in the last, month have almost put the industry to a standstill. I mean, you cannot extend the tenure of the fund, even if though there's I'm sure there are 20% culprits in the room, but I mean, when you have an asset which is that large, how do you sell it tomorrow? You can't. And other regulations, I mean, those guys know better, but this is kind of a, you sit back and say, "Yaar, humne sach mein AIF banaya tha, did we do the right thing?" You're almost getting to that pass-through stage where every fund went through a pass-through, they read through pass-through and they went to the market, and then they were slapped by a lot of litigations by the government saying, "Ye pass-through to determinate hai, indeterminate hai." It's bought the, it's really...
Kaushik, what is your view in terms of what I feel from this session is that a thrust of capital is required. So that brings to my earlier question, what is your view in terms of providing a growth capital? Whether you feel institutions should step in and take that risk now when you have witnessed demand?
As I said, institutions are always chasing risk-adjusted return. If I'm taking risk, and obviously we are not going to take risk blindsided or something. We'll see that is the project viable, is the land taken, who is the developer, what is his track record. And with all of these things, capital is still available. I mean, sitting here, we are all ready to give capital to the eligible developers. It's not that it is not available. It's just that developers also has to start thinking about that how financial institution view the entire project. What we are coming back with. As I said, it is very simple. The project has to be complete and show me that financial closure and the capital is there. So I think that it's pretty simple that way. That, if I'm putting some money into any investments, right? If we are in the business of investments, if we put in money, we have to make that money. And what are the risks I'm taking? Is it the returns are commensurate with that risk? I mean, wherever we are buying land, the land looks very attractive for customers, for developers, but it is not throwing the return relatively to me for the risk taken. Probably I might not be interested.
So to summarize him, ease of doing business, particularly for a funder of a real estate project, you have to go through many things. Your IBC, your RERA, then the AIF. Now, if you cannot extend the fund duration, I think after 3 years, if any litigation is there with a developer, my investment in that particular project, I'll have to dispose of at a throwaway price. And actually, in that way, any fund can be in a way where, like a blackmail for legal process. Okay. So our ease of doing business is getting affected day by day. That's the key problem. So risk-adjusted return, then we look for a higher return so that, in case anything goes wrong, thing is, money is required. In morning session, the one panelist mentioned that we will be having a $7 trillion economy in next 6-7 years. And the share of real estate will increase from 7 to 13%. It translates to $1 trillion economy. Now, if the real estate is $1 trillion economy, funding will be required. It will require equity. It will require equity in a big way because this kind of business cannot be done on a leverage basis. You need to have equity. But to bring equity, you need to have ease of doing business. What could be that ease of doing business? You have a very, very simplified IBC process, simplified RERA. If I have to change a developer, if a lender want to change a developer, I have to go through n number of processes to do it. If I am restricted by AIF law to conclude everything, whatever it happens, within my stipulated time, it's impossible. RERA doesn't work on my timeline. Authorities doesn't work. Code doesn't work on my timeline. And above all, these all litigations, they don't work on my timeline. I'm dependent on n number of people to complete a single project on time.
So when it comes to revival of capital investments and all, the timeline I feel is of key importance once you invest into it, be it equity or debt. What, according to you, gentlemen, I'll start with Sunil ji on, should be a safe period for investing equity, as Anuranjan insists upon that? There should be equity investment into the project by financial institutions, but that should be a patient capital provided, backed by a growth capital as well. So what is the timeline for a safe investment for a project to see, not only RES, but other asset classes as well? Because each asset class they have a different gestation period.
I wish I could answer that very conclusively. The fact is that with all the good intent, and first it was approvals, then now it is about IBC and other things, I think I've never seen a financial model that takes into account more than 3 years or 4 years for development of a project. And the fact is that most of the good projects are delivered in periods which are greater than that. So one is that we have to be realistic. The other thing is small and slim is beautiful always. So, my body size obviously cannot claim to be beautiful. But the fact is that there is this project which has to be invested in 2 tranches. What has happened also is that you've attempted to do 100-acre projects. In a economy where 100-acre projects were not done. I mean, DLF went to the market with 6 million square feet of development experience, and they projected that we'll do 6 million every year. And the market rewarded them with 535 rupees a share price. That has not been achieved even today. So the fact is that there was overexcitement in the economy. We took on very, very large projects. Developers tried to sell as much as they could on day one, not realizing that the cost cycle will catch up. So I think one is set of learnings, and those set of learnings tell me that even if you get to an architect and tell him that give me 2 or 3 proposals, there have been arrogant architects who have said, sorry, hum dusra to option dete hi nahi hai. So right from the fact that you've not had architects or construction machinery get up, and all of those is history. But I would say if you are investing in a project which is 10 to 15 acres in a city like the tier 1 cities, you should look at a 6 to 7 year period if you want to realize your equity in the most optimal manner, because the last tranche or the last building or the last piece of land that you will sell will make you a very high return, because it follows that progression, and you may have one dip in the future, because 7 years may ek baar dip, recession bhi aa sakta. So I think 6, 7, 8 years is a good period for a project of that scale. But if you're looking at a 100-year, or a 100-acre project, I think many things could go wrong. The city could, have its own laws. Your development that was proposed will never come. The proposed road on the master plan doesn't come. Your clearance from AI doesn't come, and so on. So I think private equities also learned that way. So you do not find a lot of these very large bombastic projects that can take a lot of time. But timeline should be about 6, 8 years. That's what.
What are your views, Siddharth, on this? Since you have seen how people have burned their hands in the past.
Save litigation. Save litigation. Once litigation hits, then it could be any.
No, of course, that's what I would want his views on that.
Look, I was asked a question about courts not doing their duty within time, or courts not deciding within time. Thank you, Santosh ji. He had an answer for that. But having said that, if you ask me, for every developer, time is the essence as well. I think before starting any project, the developer has to ensure that the time they're calculating in order to give possession, in order to deliver what they have promised. It's not just possession, it's the other facilities also that you promise along with the project. Once they are completed, what is the timeline? If you're not adhering to the timeline for whatever A, B, C reason. Sunil ji said, yes, the master plan, the road may not come there, this may not happen, that may not happen. You have to ultimately see the position on ground, and going by the experience, take that much of time which you give the allottee as the timeline to finish the project. If you're not finishing on time, you're running into a big mess. And that sometimes gets you in a big hole as well. I do not want to take any names, but when IREO came to Gurgaon, was such a big name, I believe. They've not been able to stand where they should have by now. And coming back to IBC, I say that the mandate of the IBC is not to see whether the company, which is before the NCLT, is a real estate company, it's a manufacturing unit. No. The mandate is that if there is a default, now that definition has been changed for the developers as well. In fact, some allottees can come together, and if there's a default of more than 1 crore rupees, they can go under the IBC code, right? So ultimately, the NCLT will only see that there's a default. Yes, the payment which was promised has not been made. Ultimately, then the ball shifts to the resolution professional and the committee of creditors. So the NCLT as such is not to apply much mind onto how the company has functioned. No, that will not be taken into consideration. The steps are defined. So the mandate is, the NCLT is not to go into the micros of what the company has done. And that's what I think.
Santosh ji, your views on this and some light. I think we are running out of time here and all, but your 2 cents on new geographical expansion, new geographies and expansion in those lines.
So Ashwini, new geographical expansions, like we have discussed that the government is coming up with a rapid metro. So expansion can happen, we can think about that, how to go beyond the limits of Gurgaon and Noida. If this geographical expansion happens, then this is good for NCR itself. When you are creating good infrastructure which is connecting, for our example, Karnal. So people will move out. You will decongest basically the Delhi side. And if you have good connections to even the NCR, Meerut, Karnal, in that side, Alwar, people will move out. And people are moving out since they are getting better opportunities in those areas and gaining from different, since they are gaining good environment there, and they are earning in a dream city and living in a green city. I always call up like this, that they are living in they are earning in a dream city and living in a green city. So if you go Karnal, it's a green city, but they are earning in a dream city, which is Gurgaon. So it's that you are earning in dollars, spending in rupee. So it happens always.
Nihar, your 2 cents on providing capital with respect to your, I will not say existing partners, but new other asset classes. What are your thoughts on that?
So I think, see, we keep evaluating other asset classes. I think residential even today is 70-80% of all of real estate. And we are evaluating other asset classes, but I think ultimately it's about being able to build a large franchise, right, around even other asset classes rather than doing them opportunistically. Also, I think we've been talking about, the right gestation period or average period. Also, it's a function of the kind of capital we have, right? I think we have all third-party money, which is investor money. Residential has had an inherent benefit of being a self-liquidating asset class, which helps you achieve certain timelines. Certain asset classes may be lucrative, but may require certain more patient capital. So I think it's also a function of how returns stack up over a certain period of time, and how you can play the cycles, right, that real estate is going to go through, in a certain period. So I think that's the approach, but we are open, and the idea is to look at other asset classes and maybe even add 1 or 2, right, in the coming years.
Well, that's interesting and nice. No, Kaushik, I would need your opinion on, of course, you were having the thesis of more the risk, more the return. But of course, I jump to what Mr. Sunil, what Sunil ji has been saying, a safe timeline for a product to cross the finishing line, in your opinion.
I think the capital has to provide through the project cycle. So if my project cycle is 4 years, I can't have a capital of under the garb of patient capital, 6-year capital. It has to be commensurate with the project cycle of the. So I would say patient capital means the capital which commensurate with the cycle of the any project, residential or commercial or be it warehouse or whatever. And which is available today. So I'm not saying that it is not available. It is available today. It's just that this, the developer has to think through that how this capital needs to be tapped. What is, as Nihar rightly said, we also have the 4 boundaries within which the funds have raised, right? So we have timelines. So it's not that the capital is taken today and patient capital means it has to be paid forever, right? It has to be paid over a timeline. And because you have to pay it within the timeline, the project has to progress in those timelines. So you have to see, so if somebody asks us what is the capital timeline that you provide, I would ask this question, what is the project timeline? And accordingly, our timeline has
that goes around. Anuranjan, your 2 cents, I'll take that cue from Kaushik. Patient capital or growth capital, what should be preferred as per you? Because you have seen the both sides.
We need both, patient capital also we need, and all I need, I wish is the spread of capital which is available. It has to go, more. Yeah, the spread has to be much, much more than. If I say that, if I have to look for developers in NCR, I can hardly list 20 people with whom I can do business. And this is such a big market. Can it be 50? Can it be 100? So the spread has to be more, and it can happen through good corporate governance and all. I think a lot of things need to be done.
To sum it up, gentlemen, what we feel, what we understand out here, capital is readily available for doing business across all timelines, across all asset classes. And with the help of, say, government or other counterparties as well, in a collaborative model or in any kind of structure, what we need to see is that how should that product cross the finishing line? When we should see the light at the end of the tunnel. That's what I think everybody developer would want and every lender would like to see. And of course, less burden on the lawyers. But thank you, gentlemen. I'll leave the dais open for any questions to the speakers.
Lawyers are the happiest. They make money in both the situations. So I think, whether markets are good or bad, I think 3 cheers for all the lawyers. But I'm not one, but yes, I envy them for sure.
Any questions for the speakers? Yeah. So I think we call this session.
Well, ladies and gentlemen, we do have time to take up at least one question. I'll give you 10 seconds maybe to formulate the question. How about that? It is not every day that you find a panel this eminent in front of you. So if you have any queries related to this panel discussion, you may put up your questions. Well, I take from that that was quite the detailed.
I have one question. Anybody who answers it, barring my student who's sitting here, barring him, anybody can answer this question, and I'll promise a free drink at the bar. Okay? The question is, which asset class in US made the highest returns last 4 or 5 years average? If you can name the asset class that made the highest returns in the US, 16% dollar terms, anybody? Okay? No. It's a very unusual asset class, so it's... No. But data centers did make 15-16%. There's one asset class that made more, and that was jails. Okay? So because there are a lot of criminals in that country who need housing, who need that kind of infrastructure, government doesn't have the money. So government in US spends more money at times on security than even basic education. So that asset class made the highest return, 16%, over a period of 4 or 5 years. So you can build jails, lease it to the government, very safe investment, safe return. So, so I saved a drink, but that gives you the diversification of what asset classes can be in, investment space. So, thanks.
Well, since we do not have any questions, what I can make out of this panel discussion is that it was quite the detailed one and to the point. Thank you very much, gentlemen. Can you please join me up front for a group picture? And to present a small token of appreciation to these gentlemen for taking out time and gracing the occasion and for the detailed discussion, can we please have Mr. Vikram Iyer, National Head Sales and Operations, CCIL, on the stage with us? Welcome, Mr. Iyer. Thank you, gentlemen. A group picture perhaps with Mr. Iyer as well.